When you look at the golden arches towering over a busy intersection, you are conditioned to see a fast food chain. You see a system perfected to deliver hamburgers, French fries, and milkshakes with relentless consistency. But to view this global behemoth merely as a restaurant is to miss one of the greatest financial masterstrokes in modern business history. The true product being sold is not the food on the tray. It is the ground beneath the building. This is the story of a strategic pivot that redefined corporate scaling. It is the story of how an ambitious salesman looked past the grill and saw a financial mechanism so powerful it would forge an unprecedented real estate empire. To understand the mechanics of true generational wealth, one must study the evolution of the McDonald's Corporation under the stewardship of Ray Kroc. In the early 1950s, Ray Kroc was a traveling salesman peddling multi-mixer milkshake machines. His route took him to San Bernardino, California, where he encountered a highly efficient, high-volume hamburger stand operated by the McDonald brothers, Dick and Mac. The brothers had revolutionized the kitchen, applying Henry Ford's assembly line principles to food preparation. Their speedy service system eliminated wait times, slashed overhead, and produced a consistent product that drew massive crowds. Kroc was mesmerized by the operational efficiency. He saw the potential to replicate this model across the country, envisioning a nation covered in golden arches. He approached the brothers with a proposition to become their national franchise agent, a deal they accepted, allowing him to spearhead the expansion of their fast food chain. However, the initial blueprint for this expansion was fundamentally flawed from a financial perspective. Under the original agreement, Kroc was selling franchise licenses for a mere $950. Furthermore, he was only collecting a meager 1.9% of the gross sales from each location. Out of that tiny fraction, he had to give 0.5% back to the McDonald brothers. The margins were razor-thin. Kroc was pouring his boundless energy into scouting locations, vetting operators, and ensuring quality control. Yet, he was barely keeping his own company solvent. He was building a massive brand, but the cash flow was insufficient to sustain the rapid growth he envisioned, let alone build any meaningful wealth. The fundamental problem was that Kroc was operating in a linear business model. He was trading time and immense effort for pennies on the dollar. Traditional banks looked at his balance sheet and saw a high-risk venture. Fast food was an unproven industry at this scale, and Kroc owned virtually no hard assets to collateralize loans. He was merely a middleman facilitating the licensing of an operational system. If a franchisee failed, Kroc lost the revenue stream. If a franchisee succeeded, Kroc still only captured a microscopic sliver of the upside. The business was scaling in popularity, but the underlying financial architecture was brittle. To achieve the dominance he craved, a radical shift in strategy was required. He needed a mechanism that provided both capital for expansion and leverage over the operators. The turning point arrived in the form of a brilliant financial mind named Harry Sonneborn. Sonneborn was a former vice president at Tasty Freeze who understood the intricate dance of corporate finance and asset accumulation. He reviewed Kroc's operations and immediately identified the fatal weakness in the business model. Kroc was obsessing over the cost of paper cups and the exact temperature of the fry vats, while completely ignoring the most valuable component of the enterprise. Sonneborn delivered a revelation that would alter the trajectory of global business. He explained to Kroc that the real money was not in a fraction of a 15-cent hamburger. The true path to dominance lay in commercial real estate. Sonneborn famously articulated that the primary purpose of the McDonald's Corporation was not to sell food. The food was simply the tenant's mechanism to generate enough revenue to pay the rent. This was a profound paradigm shift. Sonneborn proposed that instead of merely selling a franchise license, the company should acquire the land and the building for every new restaurant. They would then lease that specific property to the franchisee. This single conceptual leap transformed the company from a vulnerable licensing agency into a formidable real estate powerhouse. It was no longer about hoping a franchisee sold enough burgers to generate a tiny royalty. It was about securing a hard asset and collecting guaranteed rent to execute this vision. They established the Franchise Realty Corporation in 1956. This subsidiary became the engine of the strategic pivot. The mechanics were elegantly ruthless. Franchise Realty Corporation would identify prime commercial real estate, often at busy intersections or emerging suburban corridors. They would secure a long-term lease on the land, typically for 20 years, or purchase it outright. Then, they would construct the standardized restaurant building. Finally, they would sublease this turnkey operation to the carefully selected franchisee. The franchisee was required to pay a base monthly rent or a percentage of their gross sales, whichever was higher. This sublease structure was a masterclass in financial leverage. The Franchise Realty Corporation would often secure the initial land lease at a fixed, relatively low rate, leveraging the growing strength of the brand to negotiate favorable terms with landowners. They would then mark up the rent by at least 20% when subleasing to the franchisee. As inflation rose and the restaurant's sales increased over the decades, the fixed costs of the primary lease remained stable, while the rental income from the franchisee skyrocketed. The corporation captured the widening spread between the fixed costs of the real estate and the escalating revenue generated on top of it. This created an unstoppable financial flywheel. The guaranteed rental income provided the precise collateral that banks and institutional lenders demanded. Suddenly, Wall Street and major financial institutions were eager to extend lines of credit. They were no longer lending against the unpredictable sales of a fast food chain. They were lending against a diversified, cash-flowing portfolio of prime commercial real estate. Kroc and Sonneborn used this influx of capital to aggressively acquire more land, build more restaurants, and sign more franchisees. Each new location added another appreciating asset to the balance sheet and another guaranteed stream of income. Beyond the staggering financial benefits, this strategic pivot solved Kroc's greatest operational headache: quality control. Under the old licensing model, if a franchisee decided to cut corners, use inferior ingredients, or let the restaurant fall into disrepair, Kroc had very little legal recourse to stop them quickly. Revoking a franchise agreement was a protracted, difficult legal battle. But under the new model, the corporation was the landlord. The franchise agreement was inextricably tied to the property lease. If an operator violated the strict operational standards of the McDonald's Corporation, they were not just in breach of a licensing contract, they were in default of their lease. Kroc could simply evict them and hand the keys to a more compliant operator. This ironclad control and explosive capital generation eventually allowed Kroc to outgrow the original founders. The McDonald brothers were content with their localized success and hesitant to embrace the aggressive nationwide real estate strategy. Their conservative approach became a bottleneck for Kroc's grand vision. Armed with the immense capital leverage generated by the real estate model, Kroc was able to orchestrate a buyout of the brothers in 1961 for $2.7 million. It was a sum that seemed astronomical at the time, but in the context of the underlying real estate empire being built, it was the bargain of the century. By controlling the land, Kroc controlled the destiny of the entire system. The legacy of the Franchise Realty Corporation is the ultimate blueprint for generational wealth. Operating a business that sells a product or service is an active pursuit. It requires constant management, adaptation to market trends, and daily operational friction. Real estate, however, is an enduring asset. The land acquired in the 1950s and 1960s has appreciated exponentially over the decades. The buildings sitting on those prime corners have become indispensable fixtures in their communities. The wealth generated by these assets does not rely solely on the daily transaction volume of the restaurant, but on the intrinsic, compounding value of the commercial property itself. To this day, the true financial gravity of the company is hidden in plain sight on its balance sheet. While the public focuses on marketing campaigns, menu innovations, and global supply chains, financial analysts focus on the property, plant, and equipment line item. McDonald's owns the land and buildings for thousands of its locations worldwide. This portfolio is valued in the tens of billions of dollars. It is a real estate trust masquerading as a restaurant company. The rental income collected from franchisees consistently represents a massive portion of the company's total revenue and an even larger percentage of its operating profit. The margins on collecting rent are vastly superior to the margins on selling food. As you chart your own course toward financial independence, let the creation of the Franchise Realty Corporation serve as your guiding light. Do not settle for the meager margins of the middleman. Do not be content with simply running a successful operation. Demand more from your business model. Engineer a system where your daily efforts are quietly subsidizing the acquisition of permanent, appreciating assets. Build a structure where your wealth grows while you sleep, protected by the ironclad certainty of property rights and contractual leases. Ray Kroc's genius was not in inventing the hamburger, nor was it in perfecting the assembly line kitchen. His true genius lay in his willingness to completely reimagine his business model when confronted with its limitations. He had the humility to listen to financial counsel and the audacity to execute a pivot that transformed his industry. He took a regional concept developed by the McDonald brothers and weaponized it with commercial real estate. In doing so, he built a financial fortress that has withstood the test of time, economic crises, and shifting cultural landscapes. The blueprint has been laid out before you. The history of this real estate powerhouse proves that massive, enduring prosperity is not a product of chance or mere hard work. It is the result of deliberate, intelligent structuring. It is the result of recognizing that the most valuable real estate is often hiding right underneath your feet, waiting to be claimed, leveraged, and protected. As you move forward, analyze every venture, every investment, and every business opportunity through this lens. Seek the hidden asset structure for control. Build for longevity. By embracing the mindset of the ultimate landlord, you position yourself not just to succeed in the marketplace, but to transcend it entirely, building a legacy of true financial freedom that will echo for generations to come.